Yeah, welcome to our seminar, which, as far as I'm concerned, is a really important subject: the tax structuring for the property investor. We're not going to dwell too long on the theory or the theoretical side of it, because that's been provided. So today we're going to try and apply all these theoretical issues. I promise you, it is actually fascinating once you get the hang of it. And I have to warn you beforehand, it is, for most people, a really complicated subject or topic. And most people, for the reason that they seem to be unable to grasp the basic principles of taxation, fear tax. Apparently, most people fear the receiver of revenue throughout the world, as a matter of fact. And there's a historical reason for it. We wrote an article a while ago, probably 6, 7, 8 months ago, about the origins of property investment. And what was interesting when I did the research, Bianca and I found that the origins of property is not as old as man is. Now, if we talk about man, then of course we mean male and female. But the reality is, in the early days of Homo sapiens, property ownership did not exist. It is something that developed, and the early origins of ownership actually evolved from the doings and activities of the so-called hunter-gatherer. Now, I'm not going to spend too much time on explaining what the hunter-gatherer is, so I'm going to summarize it. Early man made a living from hunting for food and gathering food. Hunting, of course, would be meat, and for a while there also flesh. Hopefully it's not on the menu anymore. And then, of course, the gathering would be fruits and that sort of thing. Now, the hunter-gatherer was not a person who would stay in one place. The hunter-gatherer would follow for the sake of his livelihood, and those who were dependent upon him for their livelihood would then follow the food sources. Then, of course, it would mean that they would stay reasonably close or in proximity to water, of course. So what happened is, because of that combination, the fact that you need water and you need food, it would mean that these hunter-gatherers gradually started to flock together in those areas where there was water, which would attract game, and because of the water, plants would grow and vegetation. It's actually common sense. So from that perspective, bringing people into close proximity, the immediate result of that would have been conflict. Because the moment that your food source and your water source is threatened because somebody else is encroaching on what you perceive to be your territory, then you're going to try and defend it. The next thing is, of course, a good barroom brawl. Now, what then happens is, then of course you get people getting together for the sake of protection. And the next thing, of course, is that protection needs to be increased or improved, because the nature of man is to try and take what is not his. So defending that small community against invaders, of course, became a priority. Now, like anything else, the strongest survives, which would mean that from that situation, we had a development where the strong man would actually be the unofficial ruler of that small community. And from that interesting phenomenon, of course, developed the reality of the landowner. So what we had at the beginning of ownership is that the strong person who was the best hunter and the best warrior would develop into a landowner. And once you become a landowner and you allow other people to live on your land, which is basically land that you annexed, nobody sold it to you. You got there first, you're the strongest, you're the fastest, and it's now yours. And then the next step, of course, is that when you allow people to live on your land, you become a landlord. So if you're responsible for the protection of these people who live on your land, then it means you are going to ask those occupants or tenants, as we call them nowadays, to pay you something for that protection and the right to live on your land. It is only much later that the actual serfs, S-E-R-V-E, or the tenants or the occupants gradually developed the right to also own some of that land, and that was mostly a development from the Industrial Revolution onwards, where it actually really became possible for people other than the large land owners or the royalty, as it then developed, to actually become landowners. So that's a very brief history. I'm sorry that I had to bore you with that, but once you understand this, then you've already now understood the basis of tax. Because the original hunter-gatherer, when he eventually started to collect some form of remuneration or quid pro quo from the people who he was protecting and providing with land, that is just a basic form of tax. So, if we look at tax throughout the history of man and closer to home in South Africa, you would have noticed that there is one first principle about it, and that is tax is levied and collected by the authorities, by government. The next thing that we need to know about tax, which is also a universal principle, it is twofold. Tax relates in the first instance to income. In the second instance, it relates to property, capital, as we call it. Now, capital could be land, or it could be money in the bank, or you name it. So there is a definite distinction, and you'll see from the legislation that there are numerous forms of taxes levied and enforced, but you can break all of it down to two basic principles. One is income, the other is assets or capital. Let me give you a brief example. If you work on this landowner's land and you had a really good year, and you from all your hard work you were able to gather 50 bags of grain, that of course is an income, isn't it? Now, when the landlord arrives at your dwelling and knocks on the door, if there is one, then he's going to ask you to give him 1 or 5 or 10 of those 50 bags as his share. That is income tax in action for the hunter-gatherer's successors and title. So if you have now accumulated lots of assets because you've been a really productive farmer, and you now get to the point where you sell your little farming business, and you now have a lot of capital, subsequent to that sale, that is now capital, isn't it? Because it is not, it's not income that you derived in the course of earning income. It's not proceeds. It's capital in nature. So what happens now is the landlord now approaches you, or the landowner, and he says, you've now sold your business for 100 pieces of silver. So because you now made a really good capital profit, I'm going to take 10 of those silver coins. There you have capital gains tax. So the principle is pretty much straightforward. Now, is there anyone who battled with the legal jargon? Because for the purposes here, you had to have a look at the definitions in the Income Tax Act. And let me just tell you immediately, the Income Tax Act is by far one of the most developed pieces of legislation as far as tax is concerned in our country. It's already a 1962 Act, as you would have noticed from the seminar notes. But it is also a reasonably complicated Act because it's been amended and added and detracted from 1,000,000 times since 62. So you could have had a look at financial year, foreign tax year. We're going to have a brief look at that. Then taxpayer is really important. Means any person chargeable with any tax leviable under this Act. Boom, end of story. It's as wide as you can get. Then company, etc., etc. Gross income is the real important one. If you haven't had the time or the opportunity to read through it, please take the time to read through it. Because gross income is almost unlimited. And any form of income that you can derive in the normal course of your activities would somehow or another fall under the definition of gross income. And now I'm just going to refer you to a few of them. The interesting one is this. Under the definition of gross income, B, Roman 1, And remember, you have to have a look at B. It says, in the case of any person other than a resident, the total amount in cash or otherwise received by or accrued to or in favor of such person from a source within the Republic during such year or period of assessment. And here's the other important one, excluding receipts of accruals or accruals of a capital nature. Why? That's capital, and capital gains tax is going to get you. But the first thing that you need to understand is, in cash or otherwise. So what is the real importance of this? If a tenant lives in your rental property and pays you in rental, in money, 5,000 Rand a month, that of course is income, isn't it? If you look at the definition. But you have an arrangement with this tenant that says, because you own the whole block of flats, this tenant will, rather than pay you 10,000 Rand per month rental, he would get 5,000 Rand a month discount on the rental, and then he would have to take care of the building, be the local caretaker, collect keys, do inspections, arrange with the garden services, etc., etc. So what have you done? Effectively, your income is going to be 10,000 Rand a month, your gross income. Why? 5 grand you actually get in cash from your tenant. The other 5,000 Rand in value you get, and I quote, otherwise, by way of the services of your tenant. So no, your income is not 5 grand, it is in fact 10 grand. Okay, what is the problem with this arrangement from the perspective of the fiscus? Now, the fiscus, you spell F-I-S-C-U-S, and just to show you how old taxation is, fiscus is in fact the Latin word which developed from about around about 72 BC, and it is just the Latin word for the coffers of the state, the purse of the state, the Department of Finance of the government. Now, the problem with this arrangement, this tenant in your rental property, is it is particularly difficult for the fiscus to actually know about this little arrangement that you have with your tenant. This is, by the way, why it is a criminal offense in terms of the income tax legislation if you fail to declare any part of your income. So the onus is on the taxpayer to declare the income, which is not in cash, but otherwise, that you are in fact receiving from your tenant. So what is the reality? The fiscus tells you, I'm going to tax you on the otherwise, but I'm also making you responsible to declare that to me, because I, as the fiscus, wouldn't know about this little arrangement. Now, if I catch you and you fail to declare this, then not only am I going to raise penalties and interest on it, but I have the right, in terms of the legislation, to have you prosecuted and chucked in jail. It's more or less as common and as simple as that. Now, what is also interesting, which you have to keep in mind, is under gross income, the definition B, Roman 2, any amount payable to the taxpayer by the spouse or former spouse of that taxpayer under any judicial order or written agreement of separation or under any order of divorce by way of alimony or allowance or maintenance of the taxpayer. What does it mean in straightforward language? If you receive maintenance from anybody who, in terms of a court order, alternatively by virtue of the Maintenance Act, pays you any form of maintenance, it is income, you have to declare it. And again, if you fail to declare it, you're in trouble. So, I find in the normal course of events, people just don't do this. Please have a look at the rest of these definitions. The other one that I want to bring to your attention, which is also a form of income, is the following. Under gross income, paragraph E, I quote, a retirement fund lump sum benefit or retirement fund lump sum withdrawal benefit other than any amount included under paragraphs E, capital A, where in relation to a member who effectively remains in the employment of the same employer or the dependents or nominees of a deceased member, any amount in a fund contemplated in paragraphs A and B of the definition of pension fund, the rules of which provide that on retirement of such member, a portion of his benefit has to be taken in the form of an annuity, has been transferred to a fund, the rules of which entitle such member or the dependents or nominees of a deceased member to a benefit on retirement in the form of a lump sum exceeding 1/3 of the capitalized value of all benefits, including lump sum payments and annuities. Now, what is important about this? That lump sum benefit, the money that you receive from your retirement fund because you resigned before the age of 55 and you took the lump sum. Alternatively, after the age of 55, you retired from the fund and you took up to 1/3 of the money available in that pension fund as a withdrawal. That, in terms of the Act, is termed as income. Now, I have to immediately add, you're going to see today, and you would have noticed if you perhaps had a look at the notes, is that the taxation margins and percentages is specifically prescribed. So it is not as taxed as part of your general income. The tax scales are prescribed, and we're going to have a look at that. Very well. So, unfortunately, I'm going to leave you as far as the definitions are concerned, and then if you have some more questions about those definitions, please feel free afterwards to send me the questions. The next important thing, of course, is on page 11 of your notes, the basis of taxation in South Africa is because of your residence here. Now, that's not 100% true anymore, because tax have now developed to the point where there is provision in the legislation where you can be taxed on income from a foreign source. But the important thing that's universal is if you're a resident in South Africa, if you live here, then you're going to be taxed. There are exceptions to the rule. So in other words, if you are living and working in the United States in excess of 183 days a year, then for all intents and purposes, you're not a resident. Now, you can have a look at the income tax scales as they are at the moment. And those are, of course, always of importance. Now, let's just summarize quickly the tax scales. Have a look at 1.3 of the notes, page 11. There are the income tax marginal rates. The income that you earn up to 205,900 per year is taxed at 18%, and then the highest, if you earn an income in excess of 1,577,300, then of course you taxed merrily on the scale of 45%. Companies, twofold. The important thing is a normal private company, Pty Limited, or a CC. Some people actually still do have CCs. As a matter of fact, Bianca and I still have quite a few of those. That tax rate is 28%, with the exception of SPC tax. We're not going to spend any time on SPC for the simple reason that a property investment company can never qualify for SPC tax. I'm just going to leave it at that. We can deal with SPC tax separately, but the reality is, because of the definition of SPC tax, the moment that it's a property investment company, then it's per definition excluded from the benefit of small business corporation tax. So for our intents and purposes, if you invest in a company, your tax rate is 28%. However, the second part of the company taxation is this. If you're a professional practitioner, an attorney, a medical doctor, an engineer, etc., and you are practicing your profession from within a professional company, then that particular company is, as opposed to a Pty Limited or a proprietary limited, it is then called Professional Practitioner Incorporated, and the abbreviation of that is Inc. So we normally just refer to it as an Inc. Now, the interesting, important thing about the taxation of an incorporated company is that tax rate is actually 33%. So there's lots of reasons for it, but for time being, accept that those are the realities. Now, have a look at the effective tax rate illustration on page 13. Make a note of that. Have a look at it afterwards. This is in respect of dividends, and we're going to have a look at dividends today. The reality is, you declare a dividend after tax. So, if your taxable income is 100 Rand and your tax is in a Pty Limited 28%, then your tax is going to be 28 Rand. Now, what you have available for distribution after that is, of course, 72 Rand. So now, by law, you're allowed to declare a dividend. You cannot declare a dividend on the 100 bucks. It is in contravention of a large number of pieces of legislation. So, your dividends that you now declare is 72 Rand, because you decide every single cent that you have after tax, you're gonna pay that to yourself as a shareholder. Now, here's the catch. Your dividends tax is 20% of that amount that you're declaring. So that will be, in this instance, then 12 Rand. So your total tax that you would then pay, if you earn an income, you pay your income tax in a company, and you then declare a dividend to get the money out of the company, that'll give you an effective tax rate of 40%. So again, it doesn't make sense. And see it from this perspective. And this is really important that we all understand the underlying principle. If you have a property investment company, you own your properties in the company, because I've always been telling you, you don't invest in a trust because your tax rate is 45%, etc., etc. And now you tell me, okay, I have now earned from my investment activities 100 Rand, but 40 Rand of that, in any event, I'm going to pay in some form of tax. It's not much better than actually paying the 45% tax in the trust, is it? Of course, you're right. But the reason why we're dealing with this is to warn you in your investment activities not to declare dividends, because that's the tax unfriendly way of doing it. Now, imagine for a moment, if you're a professional practitioner in a practice, and what now happens is you've paid your 33% tax, which is 33 Rand. So what you now have available for distribution is in fact 67, and then 20% inclusive in that 67. So in other words, your calculation is 67 multiplied by open bracket 20 divided by 120 close bracket. So that's your calculation. So it's not 20% on top of your 67 Rand, it is 20% included in your 67 Rand. I hope that made sense. If it didn't make sense, I'll explain it a little bit later by way of numbers when we get to the spreadsheets. Now, if anybody didn't understand that, please just, when we get to the spreadsheets, remind me of that. So you're 100% right if that's your way of thinking. To earn income, pay tax, and then declare a dividend would not be particularly good tax planning. Let me give you another example. Except that is then just effectively 5% less than the taxation in a trust. If you're an individual, for argument's sake, who earns, let's say, 584,200 per year, then your tax rate is effectively going to be 36%. So the next question that you're going to ask me is, well, okay, then why on earth did I move my properties away from my personal name into my company? Because if I pay my tax there and I declare a dividend and pay my dividends tax, I'll be paying 40% tax, but in my personal name, I would pay 36%. Again, valid question, because as we in the legal fraternity call it prima facie, with looking at it just on face value, apparently then in the company it is now sort of 4% higher. The problem is this: if my income from my properties is 200,000 Rand per annum, and I add that 200,000 Rand income from my properties to my salary of 484,000, then it shoves it up to 784, and then all of a sudden my tax bracket is now 41%. That's my marginal tax rate in my personal name. So there's part of the answer. The other important issue, of course, is we also ply our trade as property investors in a structure where it is a company where most of the shares are held by a trust, because we also do estate planning. And you'll see later that if the assets are in my personal estate, then upon my death, I will again pay tax, because I will pay capital gains tax, which we're going to look at, and over and above that, I will pay estate duty, which, by the way, is also 20% on these assets which have now accumulated in my personal estate. More than that, except for these two forms of taxes that I'll be paying in my deceased estate, is on the additional value of these assets in my personal deceased estate, I will have to pay 3.5% of that to the executor as payment for his services to deal with my deceased estate after I'm gone. So you can see from an estate planning perspective and an estate tax perspective, it is ludicrous to develop your property investment portfolio in your personal name. Plus, your income that you derive from those assets will continue to go up as you pay them off, or the bonds over the properties if you do buy them with debt, which means the income that you derive from your investment will continue to increase your taxable income in your personal name, which would continuously increase your marginal tax rate. And just to show you how important this is, let's say, for example, you're sitting on the 41% income tax bracket, which is, in other words, not earning more than 1,577,300 per year. Now, let's say you earn 1.5 million and the income from your property is 200,000. Let's use that example again. That'll give you 1.7 million, which all of a sudden shoves you into the 45% tax bracket, and then that arrangement is uncontrollable. Now, what is important about this is if you pay 45% income tax, or 30% for that matter, income tax on your net proceeds on your investment activities, then you have to deduct the taxation from your calculation of your return on investment. Now, if you sacrifice 45% of your return on investment, then the reality is you end up with a pretty poor return on investment. Then it's not worth it anymore. It is as simple as that. So that's why we look at structuring. So at this point in time, let me interrupt this. We're done with companies, and then of course we're not even going to deal in much detail with the income tax margins on trust, because you all know it's 45%, and that's just beyond exasperation, as a matter of fact. So now that we've done that, those are the basic principles of income in the various structures. Is there anybody, let me just ask, is there anybody here who did not get the structure that I sent to everyone? I'm just going to have a look. Chris, Devon, Johan, all of you, did you actually get that structure? Just let me know, because I'm going to refer to it. Do I have to share the screen? Okay, let's just do that in any event. Jan got it. Sandile, Chris, okay. Every one of you got it. Please have a look at that. I'm in any event going to share it on the screen if it's difficult for you to get hold of it. Good. If we look at the structure, all of you present here today would by now know that Bianca and I specifically, as a rule, are in favor of this type of structure that you see here. Now, this one is a tiny bit more complicated, and we're going to refer to this again. The reality from our perspective is this. There's an individual, married or unmarried, married in community or out of community of property, and then again, if you're married out of community of property, it could be with the inclusion or exclusion of for a moment I lost that word. Accrual. There we go. Sorry. Now, just for interest sake, if you have your assets in your personal estate here, and you are married out of community of property with the accrual, then it means your return on investment is eroded even more because the growth of your property portfolio, if the accrual in your estate upon your death is more than that of your spouse, then it means your executor will have to pay accrual to your spouse after your death because of the capital growth of your property portfolio. Important people seldom, if ever, realize that. Now, have a look at this. To enable us to answer a very straightforward question, which is, why would I pay 40% tax here because I'm taxed at 28%? And now I'm going to do the stupid thing, and I always, I'm always, as far as my little boy is concerned, he has this issue with stupid lately. So I always frown upon his use of the word stupid and idiot. I made sure that he's not within hearing distance when I say this. If you pay 28% tax on your assets here in this company, and you then go ahead and you declare a dividend, and effectively you pay 40% tax, then you're an idiot. So please don't tell Zonda that I said this, because I told him that if he ever uses those two words again, he'll be in real big trouble. But the reason for it is the following. It means you're not doing any form of tax planning if you follow the route of paying tax and paying a dividend. So what do we do? If for some reason you're now making lots of money here, the first thing that you do is you move as much of your expenses as you potentially can into this company. All the property related expenses are in any event there. But the threshold on your personal income, if you can go and have a look at it again, I'm just going to page through my copy. For an individual is the following. If you're a person during the financial year 2021 and you under 65, then you have a primary rebate of 14,958 per year in your personal capacity. And the threshold before you start the point where you actually now liable to start paying tax is you're not allowed to earn in excess of 83,100. Now, what is interesting about this, if you take into account the primary rebates and the entry level or the threshold for starting to pay tax, then effectively up until around about 123,000 per year that you as an individual earn is effectively tax-free. So what do? You've now made 120,000 Rand. Yeah. Are you going to declare a dividend of 120? No, of course not. Because what happens is this guy, if he has no other income, he is going to get a salary because he works for this guy. So whether it be as director or financial manager or whatever may be the case, because the following will happen if you do that. You will pay this guy 6 grand per month. Sorry, you will actually pay him 10,000 per month. Now, if you pay him 10,000 a month from this company, because you've now made 120,000 Rand profit, on condition that this guy doesn't have any other income, you will have achieved the following. This guy will get 10,000 Rand per month tax-free because his actual threshold, his real threshold is around about 120,000. This guy is going to get rid of 120,000 per year, which he can deduct from income tax. So, if you made 170,000 net profit year, rather than pay 28% tax on 170,000, you will pay 120 of that as a salary to this guy or his or her spouse, which would enable you to deduct that 120,000 from the 170 year, which would leave you with a net income, theoretically, of 50,000. So that would mean that 50,000 potentially would be taxable. Now, according to my calculations, that would give you 14,000 Rand in tax, as opposed to 28% calculated on 170,000 in tax. So you can see immediately, just by doing that one small thing, you have an immediate relief, a tax relief, by just making use of the mechanisms that the legislation, as far as tax is concerned, actually allows you to do. It's there. It tells you you're allowed to do that. So it's not illegal and it's not unethical. So let's take it one step further. We will get to allowances and other potential deductions that will erode that 170,000 even more. So what happens is the following. I'm starting to make serious money in this company. And I'm now exceeding the potential deductions and allowances that I can. So what do? I, as far as possible, move all the new property acquisitions into another company. And these two hold shares in each other. Also, it might be even a situation where the trust does not hold any shares in company number 2. Because what happens, I then start accumulating my loss in the new acquisitions company. So let's call it that. Okay, I see I have caps lock on. New. Is that how you spell acquisition? I think so. If it's wrong, then I apologize, but I think that's how you spell acquisitions. You can always check it. Yep, indeed. So what I now do is I now purchase all my new acquisitions in this company because this thing is making too much money. So I'm trying to leverage the debt as high as I potentially can in this company because I actually want a shortfall here. So what I can now do, because these two are related, I can get this guy to do certain management functions for this company. When I do that, I can charge my 5,000 Rand per month from this company where I am showing a loss because my income is less than my expenditure. So by charging this guy for the admin functions and the management, etc., 5,000 Rand per month, for example, I now have created another 60,000 Rand per year tax deduction. And I'm not going to be taxed on it here on this side as long as the income that I derive from those management services rendered to this guy would not exceed the loss that I'm making in this company. Okay, there's one of it. Now, you will see I brought into this the Inc. The reason for that is so many people actually practice from an incorporated or practice in their personal names, which is not a particularly bright idea. I'm going to refrain from calling it stupid. But the reality is, if this practitioner here, no matter who it is, no matter what it is, earns in excess of 1.577,300,000 per year as a sole proprietor, because he or she is practicing law or medicine or engineering or whatever it may be in his or her personal name, then the tax level is going to be 45%. So immediately you have to, from the word go, rather bite the bullet and do that 33% tax level, which is in the incorporated company. Now, what is important about this? What we've done between these two, we can do exactly the same, because the question that we always get is, okay, now I've paid my 33% tax here, which is actually pretty nice because this guy would have paid 45%. But how do I get the money out of this thing? Okay, the first thing, of course, is, again, you pay the salary, you purchase the vehicles, etc., that you need for the practice in here, because those are tax deductible. Over and above that, you pay this guy a salary, which is tax deductible here. Over and above that, instead of buying the vehicle here, you buy it here. And even more so, another company here, which this incorporated company owns the shares in it. For example, this, or own a share in it, renders an admin service. So what happens, if I make a profit here, because I'm charging this guy 10,000 a month, then I'm taxed at 28% here rather than the 33%. So it is as simple as rendering the service and providing the invoice for those services. So you can see when we design a structure, it is designed from a bird's eye view perspective, not ad hoc. I'm quickly now doing this thing because it is useful, and then I do that. You cannot leave any one of these participants here out of the picture. And of course, this is not something that you can copy and paste, because not everybody is practicing medicine here. So this element would not be there. And it may be that this person is earning an income which is taxed at a very low marginal tax rate. The fallacy with this is, of course, the person who owns a very low income is a person who's going to struggle to build and develop a large property portfolio, because to be able to qualify for the bond finance, of course, you will have to be able to demonstrate an adequate income, and over and above that, disposable income. Okay, having said that, that's as far as we, for the moment, going to have a look at this. I'm just going to stop that share. Okay, I've shared the financial information of a property that some of you here also bought. It's in a development called a sectional title scheme called Snowden. This particular one is a 1-bed, 1-bath unit with a price of $762,300. I just need to change one detail here, because this interest rate is now actually sitting in the prime at 7%, which would change the numbers, of course. And currently, this particular property, and the explanation later on will show you how ingenious taxation actually can be. Let's just repeat. This property is purchased. It is, number one, a new and unused property, for argument's sake. This one is not, but we're gonna, for purposes of this, pretend that it is a new and unused property. In other words, this property is purchased directly from the developer, and nobody has ever lived in it. So when you take transfer, it still reeks of paint. And the tenant that's now in this property is the first occupant of this property ever. Now, immediately, for those of you who are old hands and experienced investors, what will come to mind immediately is Section 13(6) of the Income Tax Act, which you can find in the seminar notes. Over and above that, let's summarize. This is a property bought for $762,300 with a bond at 7% interest rate over a 20-year term. And there's no deposit paid here. For the first year, apparently, you will not pay levy, because what this developer did, the levy of 756 Rand per month is actually paid back to you by the developer upon registration to subsidize your first year's levies. This is why it's sitting there and not there. Now, we're going to come to this because there's a harsh lesson to be learned here. The municipal charge is 227. The agent is 526.88 per month. And for theoretical purposes, I did not add a vacancy provision here. And if you look at all these numbers, currently this particular property is tenanted and the rental is 6,586 per month. Now, as I mentioned, this is also a property where you didn't pay any deposit. What is interesting about this property, and as I mentioned, some of you present here today already bought some of these properties. This property actually starts out with a tiny little shortfall of 77 Rand and 98 cents per month, and I'm sure that will not break the bank. That increases slightly during year 2. The reason for it being, apparently you're not paying levies during year 1, but of course then you will be paying levies from year 2, and those levies would now have increased from 756 per month. It would have increased with at least 4.25%. So then in year 3, because of the increase in income, for the first 2, this particular property, the seller or the developer guarantees an income growth of 6% at the end of year 1, and they actually provide a written guarantee. So what now happens is, if we look at these numbers, we're going to use this, and as I mentioned, we're going to pretend that this is a new and unused property. So what we're going to do is we're actually buying 5 of these so that we can demonstrate that particular concept. So I hope you've all seen the numbers here. We're actually going to work with, for purposes of the tax, with number 1, purchase price, and then capital growth, which you will be seeing in this line. And then, of course, we're going to work with income there, and our expenditure, which would be a large part of that. And I say a large part because for tax, you cannot deduct every single cent that you've paid towards your installment, because the tax deductible is the interest that you pay on the amount that you've borrowed. Now, I've done that calculation for all of you, and if you pay 70,000 rands worth of installments in year 1, your tax deductible will be that interest that you've paid for that particular financial year on your bond, which is 52,787 Rand. Now, in terms of the Income Tax Act and the definition or the definitions, you'll have to declare that income of 79,000. You'll be able to deduct 52,000 per property in respect of the interest that you've paid the bank, because that's a business expense. You'll be able to deduct the municipal charges, the agent's commission, and then I'm going to show you that this guy also has to be mentioned. Okay. Now, apparently, you will have no tax liability here, because the numbers say that you have you're running at a loss in year 1. Not true, because this 936 actually refers to total income less your total installments, not interest, total installments less municipal charges, agents, commissions, etc., etc. Now, if you delete, and I'm just going to do this for the moment that you can see the effect. I'll reverse that. If you rather use that number, which is actually your deductible of 52,787, which is what you can deduct, now all of a sudden have a look at the difference that it makes. In fact, the reality is, even though your cash flow runs at a tiny little loss for the year, you actually have to pay tax, if it's in a company, on 17,000 for the year. Now, if we do that calculation, it means the following: equals, for some reason, I'm battling to get this to work. Okay. Yeah, there is some reason this is I just want to close a few other. Okay. Now, okay, apparently the computer refuses to do the calculation. But I'll quickly do it on the other side. It's 17,196 multiplied by 28%. Now, that'll give you tax of 4814.88. That's then the tax that you have to pay. Even though, from a cash perspective, 4815.44, thanks, Sandile. There we go, great. That's the tax that you will be paying. All of a sudden it's now working. Okay. Now, this is one of the issues that I encounter often, is the person says, look, let me just write it in there, the exact amount of tax is 4814.88. We're going to put it in there, 4814.88. There's our tax. And now what happens is the following. If I restore, right, there we go, 4844.14, I think, more or less. So what happens is this, as Sandile indicated, apparently I'm making a loss. In my financials, from a cash flow perspective, income versus expenditure, I'm running at a loss. But the truth is, because I cannot deduct that, but I have to only deduct that, it means I'm taxable on the capital that I have paid off. Which means I will actually incur a loss from a cash flow perspective of the following: equals the tax that I'm going to pay plus so my actual cash flow loss will be 5,780 Rand. Okay, anybody who didn't get that? Everybody happy with the principle? Good. Now I'm just going to stop the share of this because hopefully the principle is clear. Now, what we have is, I took one of the templates for the financials. Now, I hope there we go. So I chose, let's just start at the beginning. There's the independent report. So there's my index. This is a company, Blown Away Properties Pty Limited. It's been in existence since 2013. There's the index of my financials. I must just add here that we're not going to look in detail at the financial statements as if every single entry would be correct as it would be required when I do my tax return. There is a separate course in basic accounting which deals in detail with all of this, but the financial statements here is pretty handy to demonstrate the principles of the taxation. So what we normally have with the financials is there's the index. What we have the independent compiler's report, if you have one, balance sheet, income statement, notes to the financial statements with the schedules, if you have those. Then we, of course, the important one that we're going to deal with is the detailed income statement, and then the normal sort of thing, approval and statement of responsibility of the directors. Then the second part is you have the compiler's report. If you are not the compiler, then the person who drafted these financials will actually sign this particular one. Then the directors, if you are the director, I chose for this little company, Mr. Blow M. Dry. And he's the director, or Mrs. There's our balance sheet, which we're going to complete. And then our income sheet, which will be completed by itself. The notes are crucial. And our detailed income statement. Now, if we do this for a moment, let's pretend that we're in year 2019 and we purchased 5 of these brand new Snowdens. So what we do is we enter there. My annual income last year for the 5 would be, in other words, 5 times, now you can't see that that particular sheet anymore, but I can tell you it was 79032 for the year from that particular rental income. There it is. Now, that was my annual income for my 5 brand new properties. My other income, we're going to come back to it because, okay, let's do that. Now, do you remember that I said the levy, which is apparently excused for the first year, and that's how it's marketed, etc. The truth is not true. What happens is this: in terms of the Income Tax Act, you will remember that particular definition that I brought under your attention in gross income. And you can go and have a look at it again. One of those that I emphasized was the income that you derived as actual consideration, or in another form. Do you remember that? That's in the definition under gross income, and that was any amount received and I'm trying to find it quickly, in cash or otherwise. I'm going to make a note here. It is under gross income, paragraph B, B1. You can go and have a look at it. Because that amount which we are subsidized with by the seller developer. Now, to give you an idea, I'm just going to call it subsidy levy. So what happens now, that's in the definition, and if I do the calculation, I'm being subsidized that otherwise, and the calculation is 756 per month multiplied by 12 months, and I must multiply that by 5 properties. Somewhere yeah, maybe I should just look at what I do. It is 756 multiplied by 12 multiplied by 5. There we go. So in respect of my lovely 5 brand new Snowdens, the amount that I apparently don't pay, because the developer is actually giving it back to me, I have to declare that, because either the argument is that I'm getting a cashback from the developer, alternatively it falls with under sub-paragraph B1 of the definition of gross income. Okay, don't panic, you'll see it works itself out. But the reality is, if you're a law-abiding citizen, or pretend to be, then you have to declare that. Now, what we immediately can do is, you will see where I do my expenses for this year, levies, I can immediately take the levies that I've been subsidized with, and I can put it in there, because I have paid those levies, didn't I? So I get the money back from the developer. The developer gives it to me in the form of a cashback upon registration, which now means I now have to pay the body corporate that 756 Rand per month in respect of all 5. So I already have. Now let's just make this easy. Let's say my accounting fees is 13,000 for the year. My bank charges is 4232. A bargaining council, I didn't have that because I was fortunate enough not to have the cleaning in between. I actually had to have 2 of the units cleaned when a tenant absconded in the dark of the night. And we'll make this a little bit more interesting. And he absconded with a few light fittings and electrical plug cover. So I now had to clean this because my tenant's little 6-year-old boy took a permanent marker and he imagined himself to be Picasso on the walls of my lovely little flat, and that cost me 1,200 in total to have that cleaned. The commission, of course, that I'm paying the agent is, again, you can't see it there on your screen, but I have it here, is 6,323 multiplied by my 5 properties. There. I had to buy a nice little computer, but I decided I'm going to rent it just to make it easy, because if I buy it, I can write it off, in the sense, if you have a look at the notes, you'll see we get to it in due course. There it is. Depreciation. There it is. So if it's computer equipment, I can depreciate it over a period of 3 years. So let's make it interesting and say, okay, I actually did buy a new computer, and I'm now depreciating. Now I don't see depreciation here. Okay, so I'm just, instead of calling it computer expenses, for purposes hereof, let's call it depreciation. And I bought it, I paid for it 12 grand, and I can write it off in a straight line over 3 years, which means I'm dividing it by 3. So my depreciation for this year, for this financial year, is 4,000. Have a look at that. It means next year I can depreciate the second year's depreciation, and then the year after that it's the last year that I can depreciate the 12,000 rand that I spent on the computer equipment, as I have, according to SARS, 3 years to depreciate it over that period. Now, you remember that I said to you, don't stress too much about the fact that I have a 5,000 actual cash flow loss because of my theoretical tax liability. This is where this kind of thing becomes really important. Okay, you remember I said to you, you now buy your new computer, your new telephone, etc. You do not do that in your personal name. You do it in this company. And you will remember I said to you, okay, we're going to pay you the 6 grand per month, for argument's sake, equals, or your spouse. Let's go wild and say, okay, it's 10,000. And it's, of course, 12 months. I'm not going to give myself a bonus. So there it is. Electricity, water, and municipality. Now, my tenant will pay the electricity because it's prepaid, so I'm not going to pay the electricity and the water, but my municipal charges is 227 per month. So that will give me 2,724 per property per year. So I'll multiply that by 5. And there's my expense for my municipal charges. My insurance, I decided to do 2 things. I took out, for some strange reason, rental insurance, and again, I'm on the brink of calling that stupidity. Why? In this particular instance, in Snowden, the seller is providing a written occupancy guarantee. What it means in writing in the sale agreement, the seller or developer guarantees for the next 2 years the rental income. So in other words, if it's vacant in month 9, there's nobody there, then the developer will actually pay me that 6,586 Rand for that month. And if it's Novid next year, new COVID, and for 3 months the tenant doesn't pay, then again, lo and behold, the tenant will pay me that. But because I didn't realize that, I took out rental insurance, which is approximately 3%, is 3%. Let me just do that. Of my monthly rental, which is 6586, and I must multiply that by 5 properties because I didn't think clearly. So I spent for the year, that must actually be, as a matter of fact, times 12. Am I right? Nobody caught me. That's what lawyers excel at, not getting caught. Aha, there we have it. So motor vehicle expenses I didn't have because I still had my vehicle and my personal printing and stationery. I bought a few boxes of paper and some cartridges, and 3,278 was what I spent on it. I didn't pay any rental, so I'm not going to have that. And the repairs and maintenance, there I have, because the 6-year-old cave dweller of my tenant made quite a mess of it, and so I had to actually repair 3 tiles. Divan, if you're still online, so I had to ask Divan to go and fix it. And when the boyfriend attended, he put a fist in a rage through a bathroom door because she locked herself in the bathroom, etc., etc. So in that one particular unit, I had maintenance to do to the tune of 5,478 for the year. Salaries and wages I paid myself, so I'm not really going to bother with that. Small items, not really. I didn't have staff to train, and staff welfare I also didn't have, but I got a cell phone to purportedly phone my tenants when they don't pay, etc., etc., and I had to get a very nice unlimited Wi-Fi. So that was 2,000 a month, and that'll give me 24,000 for the year. Am I right? Now what happens is this. If I, during year 2019, have now all of this, so from here on in year 2020, just to all of this is now going to go up for argument's sake. There we go. So that'll be my income from my rental in 2020. I won't get the subsidy again, so that's going to fall away. And I predict an increase of all of these. Of, let's just call it 4.5%. And then what I can do is I can copy it through. There we go. Now, what happens is you can see the following is during the first year, my income is that plus that. So my expenses at this point in time are far less than my income. But what I still have, and I'm going to replace bargaining counsel with interest bond. So what I do is I know my interest equals 54. You will remember I have that calculator that did this for me, and I must multiply it by 5 properties. And there we go. That one is actually not going to be the same because my interest will be less in year 2. I also have that number on that. I see Divan got lost somewhere along the line. So you can take my word for it. The interest for that particular amount in year 2 is that 369, and I must multiply it by 5 properties. Okay, so what is the result of that? I'm running at a definite loss of that in year 1, and it even goes up in year 2. Now, the question is, can the company actually afford this? No, it cannot. So, to foot the bill of this shortfall, I can now go and lend this money to my company as the director and shareholder. And if I want to incur more expenses here, I can charge as an individual interest on that shareholder's loan account. Now, let me show you something here. Let me just see who's asking a question. Computer depreciation, you're absolutely right, Johan. Thanks for catching me. Johan just pointed out that I inadvertently made a tiny little error there. As I said, it remains 4,000 throughout. Okay, thank you, Johan. So what happens now is if I lend the shortfall at the end of the year to my company and I'm going to charge it interest, let's do the exercise. We say, okay, is that, now I should have said minus that, multiplied by, let's just first try 5%. Okay, as a matter of fact, we can make it 10%. Now, why am I doing this? I would rather lend the money to the company and charge interest at 10% on my shareholders' loan account. The reason for it being, I have, in my personal capacity as a private person, a primary interest rebate every year to the tune of 23,800 per year, which means I can deduct the interest that I'm going to add to my interest on the bond. So I'll have a separate entry year. And what I'll do is I'll say interest on shareholders' loan account. And what I'm going to do is I'm going to say, okay, I'm using that amount. Okay, for some reason it refuses to do that. I understand why. Okay, it's my stupidity. It's there we go. Now, if my shareholders' loan account remains the same in financial year 2020, then of course I cannot escalate it, because depending on what I decide my interest rate to be, it would then actually be the same as that. Now what happens is, it means I have that deduction for the financial year in the company. But Uncle Gert is actually receiving that income being interest from the company. Whether I pay it or add it to my loan account doesn't matter, without any tax liability, because I have a primary interest rebate. That's what we call it. It's a primary interest rebate. It means if I receive interest and I'm younger than 65 years, then what will happen is the first 23,800 Rand interest that I receive per year will be tax-free. If I'm over 65, then that amount goes up to 34,200. For a moment, I'm unsure of it, but okay, it's more or less there. So, less than 65, over 65. Now, if I'm really clever about it, I will say, that's me, and that's my spouse. Maybe I should try and spell it correctly. So I can actually double up my spouse as the same if I have a spouse. So effectively, if I split that, if I lend money under my name and that of my spouse to the company, and I charge 10% interest, then the reality is, if I'm younger than 65, then the total tax-free income that I can get in interest from the company would be 47,600. And if I'm older than 65, then it goes up to 68,400. Nice, isn't it? Good. Now what happens is I have to actually have the paper trail. There must be a document that says I'm lending it to the company. There must be a resolution by the company that says we are borrowing 120,000 or whatever may be the amount from our shareholder, and we resolve to pay 10% interest on it, and either we will, and probably in this instance, because we're running at a loss, we are now going to add that debt to the existing loan account. In other words, we're going to capitalize this interest here. Now, that's insurance. Where's my interest? There we go. There's my interest. So there has to be a company resolution, because we need a paper trail. If the receiver is asking me for it, I can pull it out immediately, and there it is, done, dusted, and signed. Now, in the notes, you will not find primary interest rebate. The reason is, if we have to add every single little rebate and deduction and allowance, then you're not looking at 60 pages as it is at the moment. You'll be looking at 1,000 pages. I think it's 60 pages. Actually, it's a blatant lie, or I misdirected myself. It's actually 53 pages as it is at the moment. But I'm telling you now about this, and this is where we use it. So what now happens, you can see how different this picture is from what we looked at when we looked at the Snowden analysis. Is this company is running at quite a dramatic loss. 122,000 here, 150,000 there. Now, the truth, of course, is one could argue that it's going overboard if questioned. So how can I pay myself a director's fee if the company is not making money? That, of course, is potentially a valid question. And the reason would, of course, be, and here's the interesting issue. The receiver of revenue is not asking whether you're a stupid businessman or not. The receiver of revenue is asking, are these deductions valid and lawful? And if so, show me the paper trail. Now, this is a company. It has to have a director, and somebody has to do the work. Let me just see. Johan, great. Johan has to be elsewhere. Not to worry, Johan. I'm sorry that you have to go off. I hope everything will be sorted out. Please let me know that everything is sorted and done. I will send you the link, and enjoy the rest of your weekend. Okay. So, okay. Ladies and gentlemen, I think this is an opportune time you would have noticed in the notes that we mentioned the issue of lump sum benefit tax. Now, all of you who are contributing to a provident fund or a pension fund, which is provided for in specifically Regulation 28. We have a separate course specifically dealing with estate planning, and part of that is where we deal with insurance requirements and retirement planning and estate planning. Now, in that we deal in detail with Regulation 28. Briefly, Regulation 28 is in terms of the legislation dealing with the pension schemes and provident schemes, which simply means the following. If you contribute to a provident or pension fund, which is regulated in terms of Regulation 28, then it is compulsory money. It means until you turn 55, you cannot withdraw any of those funds. There's one exception to the rule, and it is this guy here. If you retire, this is applicable, this. But if you resign your employment prior to retirement age, now minimum retirement age is 55. So if you resign before age 55, then, and you want to take the money in that retirement or provident fund, then what happens is this. Now, it is not voluntary funds. It means when you resign, you're now withdrawing all of it. It is an interesting tax phenomenon. And I want to show you this, how expensive an exercise. And many of you would have heard in the past that I'm critical of RAs, or retirement annuities, except for the fact that it is my belief that these retirement annuities do not perform anywhere near as well as the growth in a carefully selected property. It is also a reality that you have absolutely zero access to those funds, notwithstanding the fact that it might not be performing at all, not growing, or it might even be moving backwards. So that's the angle of approach when I'm critical of an RA. But one has to add to this is an RA is a very nice tax advantage if you have the money to spend. Because what happens is all your pension contributions, up to a maximum of 27.5% of your annual income, you are allowed by law to spend on retirement provision in an approved retirement fund or provident fund. So if I can do the number, if you earn 1 million rand per year, then you are theoretically allowed to spend this per year on pension fund or provident fund contributions. It is 275,000. Now, if your salary is 1 million and you taxed according to that at the 41%, then theoretically, you as an individual is supposed to pay, and I say theoretically because you have primary rebates and thresholds, etc. But in theory, if you earn 1 million, then you're going to pay 41% tax, which means your tax would be 410,000 per year. Now, if you contribute towards a pension fund now the same applies to medical expenses to a large degree, but the only reason why we as property protectors, investors, from time to time actually do invest in RAs is because of this. Because what happens is this, is you're now allowed to reduce your taxable income with those pension fund or provident fund contributions. Now, if you now do the calculation, if your taxable income is now down from 1 million to 725 million, then it means you have now dropped to the 39% marginal tax bracket. Now that makes quite a dramatic difference. Let me show that to you. Equals, that's your taxable income multiplied by 39%. So the difference, if you want to do that calculation, is actually quite significant. By doing that, you have a saving of 127,250 per year in tax. Now, why do I say it's theoretical? Because if you earn R1 million per year, what most people do is they adopt a lifestyle which reflects their income. And most people simply do not have in their cash flow that 275,000 per year to spend and remove it from their cash flow. So that's why I call it theoretical, but there are instances where it can be done. Now, if, for example, you say, well, okay, I'm allowed 275, but I'm just going to spend 10,000 per month, which will make it 120,000. Then the numbers change. But if you're now sitting at 880 per year, then you're back in the 41% bracket. Now, then the numbers change like this. Now you can see this is a numbers game. It is about budget. Of course, budget implies income and what are your living expenses. What we call the essentialia or the essential expenses. You have to live somewhere, you have to either rent or buy, you have to drive, food, clothing, water, electricity, etc., etc. So, this is the reality. Once you start doing this, then you have to have the ability to run the numbers. And part of the idea with a taxation seminar is to provide the information that you can go and have a look and see on page 11 of the course notes are the marginal tax rates. And then you can say, well, okay, if I do this, I will end up in a 39% rate or in the 41%, and how will it affect? But you can see, if instead of double this, you do the 120, which is still 10 grand per month, then my saving in tax would be 49,200 a year, which is not a small amount, but okay. Now, once we've said that, can I delete this? You can see it afterwards on the video in any event. Happy if I delete this? Going, gone. There we go. Okay. So in the instance where as a natural person, in other words, not in a company, not in a trust, there's one exception which we're not going to deal with today. It's a special trust, because a special trust is taxed exactly like a natural person. But as a personal person, a natural person, if before the age of 55, you resign or get fired or get retrenched or COVID or Novit or whatever that hits you, and you're now not working at your current employer anymore, and you choose to withdraw that whole benefit, and it is, for argument's sake, let's call it 2 million. These are the numbers. These are the scales, and you will remember I brought to your attention the fact that this is considered to be income, the money that you take from this fund. Why is it? There's a principle in tax law that says if you get the benefit and you reverse that, you have to give that benefit back. So I have had all along the deductions of my premiums to get to that 2 million. I've had a tax benefit for it. I was allowed to deduct it from my gross taxable income. You remember the exercise that we did here? So I received, let's just go back quickly to that. Yeah, I received this benefit because I contributed every month 10,000. Now I'm taking it back, and the receiver tells me, wait a second, every year you saved 49,200 in tax. So now you're taking that money in respect of which premiums you had this tax benefit. So you're getting this money back now, I'm now going to tax you. But what one has to understand is the higher your income bracket, the easier this becomes. It makes it at a certain point almost worth your while. Why? Because if you're in the 45 or the 41% tax bracket, or even the 39% tax bracket, then it's worth your while to take the damn money. Let me explain this to you. You received a tax deduction calculated on 41% or even 39%. Now, if you look at this, the first 25,000 that you take from here is completely tax-free. So immediately you score the tax on 25,000, being, if you do that calculation, equals 25 multiplied by 41%. Immediately you score that. Let's do it in this column. There we go. So already, because you had a 41% deduction on that, and remember what we did is we said, I got a benefit of 41% on 25,000 that I put in there. So I got a 10,250 Rand benefit, but I'm now getting it mahala, for free. So if I do it with this one as well, and I say, okay, equals and I multiply that by 41%. That's the benefit that I received. But I'm now paying 18% on it. So that 18% is 114,300, but I got a 41% benefit. Sorry, I must just deduct that, minus. So look at the benefit that I'm getting, 146 0.50, etc., etc. Now, what it means, if you just, we don't have the time to extrapolate all of this, but up until here, you actually, notwithstanding the fact that you're now going to pay tax on something in respect of which you had a previous tax deduction, already at this point, you score 156,300. So does it make sense when I say, if you retire, if you resign before age 55 and you're going to take the money, it's worth your while. But there is a massive caveat. Caveat is, again, just the fancy Latin word for a warning. Let's do that in red. Caveat is a warning. You must remember this is savings. Yes, by taking it, you're actually gaining 156,300 already at this point. And just to make the calculation easy, there we go. What now happens is, on that 660,000 that you have in there, you literally get a freebie from the receiver of revenue of 156,300. Now, the caveat is this. This is savings. And this is meant to provide for you at that point in time that you don't want to or cannot work. So if you take this and you buy a boat and a Harley Davidson and an overseas trip, then, as my 6-year-old puts it, then you're an idiot. Because that saving, or that little parcella that you get from the receiver, is then completely wasted. Then you've saved all those years just to blow it, and you're sacrificing that nice little benefit. But if you take this money, this 660, and you put it into an investment that will grow, every single cent of it, minus, of course, the tax that you're going to pay on it, and you a deposit towards 2 or 3 properties or whatever tickles your fancy, then, of course, it makes a lot of sense because of that. Okay, once that is done, the important thing is the following. If your lump sum is what you take, in the sense that you take a third, you remember there in the definitions, under gross income, let me just add this. When you do the reading, on page 11, there's a definition in the Income Tax Act, income. It reads, income means the amount remaining of the gross income of any person for any year or period of assessment after deducting therefrom any amounts exempt from normal tax under Part 1 of Chapter 2. That's the specification of all the tax tables. Now, what happens is this. After the age of 55, if you retire, not resign, if you retire, and in your fund you have 2 million, let's make it 6 million. You're now going to take a third of the 6 million, which is 2 million. That 2 million, the first 500,000 is exempt from tax. The second part, 500 to 700, is a tiny percentage, 18%. So up to this point, it's 36,000 in total. Then if you go over the 700, then it becomes more significant, 36, 27%, and then above $1,050,000 is 36%. But again, this, if you extrapolate this kind of thinking, then you can see the freebie that you get from the receiver simply because you had the deduction previously at, for example, 41%. Now it's worth your while. Again, on condition that you don't go on a spending spree with it. You reinvest it in something that will grow and that will give you recurring, regular income, which income in the third instance will continuously increase. So what is it? Property, investment property. Now, what happens is it's not as if you lose this money, because in the past, you had more income because of these deductions that you had in respect of the contributions that you made to your pension scheme. So you're not losing it here. You're only giving a part of what you received previously from the receiver back. And I call it a part because it's nowhere near the benefit that you actually receive. Now, the second step to that, of course, is that you have to invest it wisely. Because if you sacrifice 472,500 of your 2 million and you end up with 1,527,000 and you invest that wisely in property and you do the following. You say, okay, I say that plus, now I'm going to do the following. I'm going to add my 6% capital growth and my income, if I get on my property, rand for rand, in other words, let's call it a 0.9 rental, then that'll translate to approximately 10.27%. So plus that multiplied by my 6% capital growth plus my 10.27% income that I derive from it, that gives me 17.27%, 17.27%. So after year one, what I've derived in benefit, capital growth, together with my income that I received from it, is then 1791. Now, if I repeat this process, let's copy it. Now I have to. Aha, have a look at that. So what I've done now is I did the same calculation based on what I had here. So if you take your lump sum of 2 million, you sacrifice your interest. With what you get, you buy your property. Then, on condition that I get a 6% capital growth and that I get sort of 0.9 in rental. In other words, my property I buy for 500,000 and I get sort of, yeah, more or less 4.8 per month. 4.5 per month, am I right? So if I get that 4,500 per month, and I get my 6% capital growth, then it means at the end of year 3, I will recoup not only what I've paid the receiver, but I will actually make a tiny profit, because then I'll be sitting at 2.1 million, and etc., etc. Have a look at that. There we go. So it is a fallacy to say that you have to leave your whole 6 million in your pension scheme, because what you're going to do when you retire, you take your 6 million and you invest it in either a life annuity or a living annuity. And from that, you'll have to derive an income. Now, by the way, you're not allowed to deduct or to draw against your living annuity less than 2.5% per annum. So if we do that calculation and we say, okay, it is 6 that I have in my fund. So now in year 1, I'm going to deduct or withdraw from my fund my minimum 2.5%, which means I'm going to withdraw 150,000 from that fund. Now, it is on the hypothesis that I will have at least 2.5% growth in the insurance company or on my living annuity. Otherwise, I cannot take that money. But the law says I'm not allowed to take less than 2.5%. Okay, so if you divide that by 12, it gives you a measly monthly income of 12,500. Now, you can then understand why I say, take that after you've done the calculations, because this is where you want to go. Because if your property gives you a 1%, then it means equals that multiplied by 1%. And lo and behold, in year 1, you okay, so what happens is the following. And I know it sounds complicated, but this is why we're actually doing the numbers. If I say in year 1, I invest that money in a property, then what should happen if I expect a 6% income growth is that plus that times 6%. So, etc., etc. So this is the curve that I get by actually taking what I can from my pension fund. Whereas in this instance, I will not have the same increase. If you look at that. Okay, I hope that's clear. Now, this is the reason why we actually look during these seminars at retirement or lump sum benefit tax. Because what do I do with this 1.5 million rand? Is I take this money, and do you remember that structure? I lend it to my property investment company with or without interest. And on the side, I receive the 2.5 per year on what is now 4 million rand in my pension fund, which means 8,333. And then in the company, I get this income, which means that either I pay myself the salary, there we go. Alternatively, I charge the interest. So the sum total of the investment is the 15,000 that I derive from that investment, plus the pension, which is 8,333, rather than 12,500, which I will withdraw from my pension fund, being the 6 million. Okay, I hope that made sense. Now, anybody who had a problem with that? Great. Now, the next one that we're going to look at is the usufruct calculation. Okay, usufruct is a structure which is literally 2,000 years old in our legal system. Usufruct means the following. I have the right, which is registered against the property, to the use and enjoyment of land, the property. Where does it normally come in? In other words, I don't own the naked ownership. The naked ownership belongs to my company. I've now transferred my primary residence or ex-primary residence, or any other property for that matter, to my company, my property investment company. But rather than taking the whole thing and transferring the whole thing unencumbered to my company, I reserve the usufruct. Now, I've just explained what the usufruct is. So, if I do that, it means I and my spouse and I, if I so choose, if we married in community of property, that is, will then have the right to occupy, enjoy it, and derive the benefit from that property. In other words, take the rental income. So the company owns just the shell, the naked ownership. It has no right to the use and enjoyment of that property. Now, why would we do this sort of thing? Let's say, for example, here's the calculation. Now, if you read the notes, you will find a reference under usufruct to table A and table B, the expectation of life of males and females of various ages. It is calculations, a whole list of calculations. If you're interested in it, I will send it to you, but it's as a rule not necessary, because somebody like I would do those calculations in any event. Now, we're not going to dwell on the technicalities, but what it means, these calculations are done with reference to the actual value or the pre-usufruct price. So for argument's sake, my next birthday, this is the value of the property that I'm now selling to my company. My next birthday, I'll be 58. I think so, but that's more or less. Now, there's a calculation prescribed in the legislation that says the current value of what that value will be at the end of my lifetime is 360. This is for purposes of calculating. Now, just to give you an idea, if I sell the property for 3 million rand, my transfer duty will be the following. The company will have to pay 146,000 rand in transfer duty. Please have a look at the definition and the description of what transfer duty is in the notes. So, remember the 146, I'm just going to add it there. There we go. But because I'm reserving in my favor the usufruct over this property, and it could be primary residence, for example, or the little house on the beach, or the weekend property in the bush with the boma to build a fire and listen to the crickets and the howling of the jackals, whatever it may be. So what happens is the following. There's the calculation, the formula that's applicable in Table A for a person who is a male and whose next birthday will be 58. Then the value of those rights that I'm keeping back, holding back, or retaining is 2.5 million. So the value that the buyer, the company, actually buys is 497,000, even though the actual fair market value is 3 million. So what does it mean? If I use that, rather than pay 146,000 in transfer duty, and if I make use of the usufruct, then I pay 0 transfer duty. Okay, and this is really, really interesting because transfer duty, this usufruct just saved me 146,000 rand, or the company, or both. So, what is the important thing? Let's say I actually pay the transfer duty. That 146,000, the question is it expenses? No, it's not. It's actually capital gains deduction. So, if I, as the seller in the contract, state I will be paying the transfer costs and fees, then it means I, as the seller, will have to pay the receiver this 146,000. Now, I cannot deduct it from income tax for this financial year. But if I bought, and let's do that exercise. Let's go to the capital gains tax. My input was, for argument's sake, 2 million. There we go. Over and above, I did some alterations and additions. So I expended capital on it. In other words, I removed the carpets and I had it tiled. I removed the kitchen cupboards and the stove, and I spent another 200,000 on this new fancy kitchen. In other words, it's not maintenance. Maintenance is a deductible expense, but this is of a capital nature. You remember that definition. So all in all, with the tiles that I had laid, that was 50,000. Plus the kitchen was 200. Plus what I now have is I'm now going to spend 146,000 on transfer duty. Plus, I'm going to pay the conveyancer 41,200 towards the transfer costs and fees. So, I'm selling it for 3 million. So what happens now, if I'm a natural person, then the capital gain will be if I do that, my capital gain is going to be 3 million being my actual selling price because I'm not using the usufruct, less what I paid for the place, less the capital expenditure. So what now happens, my capital gain is 562,800. So how do I calculate that? As follows. Let me do it here. As a natural person, I have a gross capital gain of 562,800, but I have a primary rebate of 40,000 Rand as a natural person. And now what happens if I first enter it through? Now the amount that I will use for my calculation henceforth is 522,800. So what I then do is I'm a natural person, and I just want to say that is there's my 40. Just want to put it in there. Sorry, 40%. If I'm a natural person, then it means my net multiplied by 40% multiplied by whatever my marginal tax rate is. Now, I'm just going to fill it in now because that is 0. So let's say I'm sitting at 41%. Let's use that same example. My capital gains tax as a natural person will be 85,739.20. Now, that is tax, but it's not income tax. It is capital gains tax. And I declare that in my tax return at the end under Schedule 8. So what happens is the following, just for interest sake. If I change these numbers and it's a company which is selling, then that number becomes 80% and that number becomes 28%. Now have a look at the difference. 85 as opposed to 117,000. So let's just do that, 85 and 117. Okay, that's private person, company. Now let's go overboard and say it's a trust that's selling, making this capital profit. Then that remains 80%. That becomes 45%. Now have a look at that. Then it goes up to 188. You see, so if I'm a natural person, and now what we have to understand, this is on the understanding that this is not my primary residence. Because if this is my primary residence, then I can tell you now there will be no capital gains tax, because the first 2 million rand in capital gain will be exempt. So on my primary residence, I can make a profit of 2 million rand and not pay any capital gains. And it's important that we understand this. But okay, for argument's sake, this is not primary residence. So even if I'm a high income earner, there's my capital gains tax. Now what happens is the following. Have a look at these numbers, how they change. If I choose to reserve the usufruct, and I do this, then no transfer duty, and have a look at the capital gains. Okay, it's now gone and done the negative, but that should actually be red. Let's just do that. Okay. For some reason, a circular D43. I think I have to have. Okay, I'm not gonna. Okay. Well, in any event. So what happens is, if I reserve the usufruct, no transfer duty, and then no capital gains. I'll have to struggle a little bit with the easiest way actually to do that, because it's now irking me. If that minus that is less than 1, then that should do it. It still refuses to do it. C41. Huh, interesting. Okay. But in any event, I hope everybody understood that, especially my battle with. Now what happens is the following, is by changing something up here, you can see it has a dramatic immediate impact on transfer duty, and the dramatic immediate impact on capital gains. Now, the interesting thing about this is that none of this has an impact on my income and expenditure. The only instance where I can actually deduct legal costs here is when, for example, there's a tenant who's recalcitrant, not paying, been sitting there for 6 or 7 months during COVID, lockdown, and I now instruct Bianca to proceed with an eviction. That is not of a capital nature, because that's an expenditure incurred in the process of earning income. So that is in fact an expense. But transfer duty, as I mentioned before, that's not an expense here. It is of a capital nature. Now, I see I don't even have legal expenses here. So what happens is, when we look at this, is the following. We spoke about lending money to the company, selling properties, paying or not paying transfer duty, using the usufruct or not, paying or not paying capital gains tax. But in all of this, we have the potential of Section 7C. Now, that's a form of tax if I'm a connected person and I lend money to the company or the trust and I don't charge any interest, or I charge actually less than the official rate prescribed by the Receiver of Revenue, which is 4.5% at the moment, then I'm going to be receiving a tax bill. Now, how does 7C work? You will see in the notes, we refer to donations tax. If I make a donation, I will pay 20% tax. So let's do that exercise quickly. If I donate 1 million rand to whatever and whomever, I will pay of that to the receiver 20%. So I will pay the million and I will pay the receiver a donations tax as the donor. I'm the donor, has the obligation to pay 2 million rand, 200,000. So, however, the Receiver of Revenue offers me an annual primary rebate of 100,000. So it means I can actually donate 100,000 rand tax-free per year. Now what happens is this. If I do the following, I lend money to the company. My loan, shareholders loan account, is, for example, 2 million rand that I've now, at the 28th day of February 2021, the company owes me on my shareholders loan account 2 million. What now happens, I am supposed to charge on this a minimum interest of 4.5%. There we go, according to the Receiver of Revenue, because that's the official rate. So that will translate to the following. That guy multiplied by 4.5%, which means if I adhere to the demand of the receiver, I will have to add to my income in my personal name 90,000 Rand for the year. If I am on the 41% marginal tax rate, then it means the following. I will pay that multiplied by 41% tax on that interest. Not really true, because what happens is the following. Is I have a primary rebate of 23,800 because I'm under 65 for a few more years. So my tax that I will have to pay on that interest that I'm charging the company on my shareholders loan account is 27,142. So what I now do, if I prefer not to charge that interest, is the following. The receiver says, okay, if you have to charge 90,000 Rand because of Section 7C, then you are still under your annual primary rebate. So what happens is the following. It means if I don't charge the interest and I lend 2 million Rand to the company, I can still claim my 100,000 Rand rebate for this year if I don't charge the company interest. So let's just do this for interest sake. Let's make that 2.5 million. Now look how the numbers change. Now I will have to, I've lent 2.5 million. So either I can choose to pay tax to the receiver for the year of 36,000. Alternatively, I can do the following. I can say, okay, the interest that I should have charged and didn't is that, minus my primary rebate for the year of 100,000. And please do yourself a favor and go and have a look at the discussion of the 7C tax. I must just actually find that in which we have it. Dividends tax, capital gains tax, estate duty, there we go. Transfer duty, okay. It is in chapter 3 from page 29 onwards. Please do yourself a favor and go and have a look at it, because the theory is actually not difficult. So, there it is, all the way to page 32. Have a look at that. And it is in the 8th schedule. Okay. So how does it work? I should have charged 112,500 in tax, in interest. I didn't. So now I take that amount that I didn't charge and I deduct from that the 100,000 Rand, which is my primary rebate that I'm entitled to. And what I then do is I multiply that by 20%. Why 20%? Because that is the percentage applicable to donations tax. So if I donate something, I take the value, multiply it by 20%, and I pay their donations tax. Now, this is the basis of Section 7C. I was entitled to donate 100,000. I donated in effect 112,000. So now I have to pay 20% of the 12,500, which exceeds my annual rebate. And this is the result. Now I want to show you this. Have a look at this. Once a year, I can choose. Either I'm going to charge the interest at 4.5%, but lo and behold, when this interest rate goes up, that amount will go up, and the amount that I can lend to the company without having to pay donations tax or 7C tax will decrease. So the reality is the following. If I'm being an idiot, I can lend the 2.5 million rand to my company, and I can charge it 4.5% if it can afford it. And the 112,000 will accrue to me, less my 100,000 will accrue to me, and I will pay 36,367 rand in tax for that financial year in my personal name. Alternatively, I can lend that money to the company, refuse to charge interest, and pay my 7C tax of 2,500. Now, look, guys, this is a no-brainer. So what do? If I need that income in my personal name, then I charge the interest. If that's my sole income for the year, that interest, then it means I have the primary rebate, and it effectively means I will not pay any tax on that interest income because it's below the threshold of approximately 123. But if I don't actually want this income, and if I don't want to pay this tax, then I refuse to charge the interest, and once a year I pay the receiver his 2,500 rand in respect of 7C tax. This is actually as easy as that. Now what happens is, if you look at your income statement, there where we talk about taxation, what happens is the taxation applicable in terms of 7C will not be reflected in the company's books, because the person who's liable for the 7C tax is the person who is supposed to charge the 4.5% and didn't. That's that's Uncle Gert. So I have to reflect that 7C tax in my tax return, not in that of the company. So it has no impact there. But what is important, if I charge this 112,500 in interest, then let's change that. Will then have the following impact. Equals that, you remember that 11,000, it was the interest that I charged on my shareholders loan account, plus that interest. I hope I got it right. There's 11, that's right, yeah. Now have a look at the impact here. I had an 11,000 deduction in the company for the interest that I charged on my shareholders loan account. But if I actually proceed, the money that I lent to that guy, the company, in terms of 7C, I prefer to avoid 7C and actually charge the interest. Then I will, if I have no other income, not pay any tax in my personal name. If I have other income and I'm sitting on the 41% tax bracket, I will pay 36 grand extra in my personal name in tax, but the company will have an additional tax, and have a look at that, 235 loss that I can fabricate. Now, the interesting thing is, it is a combination of all these things that will make up my taxation here in this company. Now, have a look at how the system is now completing this for me. My balance sheet, of course, there my properties and plant I must still insert. But if you look at your notes, I just want to make sure, long-term borrowing, what happens here is my long-term borrowing is, of course, the bonds on my properties, and then the shareholders' loan accounts. Okay? And now what happens is the following. You can see I have no tax liability. But let's change this for interest sake, because we're now going to have a look at 13 Secs. Now 13 Secs is pretty damn easy. I purchased, let's do the numbers. I purchased 5 properties, and they each cost me, you remember the Snowden, 762,300. That's what I paid for my properties. Now 13 Secs works as follows. It says, okay, you're allowed, and again, please do yourself a favor, and 13 Secs is dealt with in chapter 2 from page 18 onwards. Now 13 Secs is crucial. And if you have a look at page 19 onwards, and specifically on page 26 at the top, there's the nice calculation. Please have a look at 13 Secs and to some extent 12N, because this allowance, this is called an allowance. I just want to add it in there. So what happens is the receiver says the following. There's my inclusion rate, which is what it's called. So in other words, it says what I can include is 55%. So what I do is the following. I say that multiplied by 55%. That's the amount. For some reason, I did something stupid here. Okay. That multiplied by 50%. Okay. So the amount that I can include in my claim is 2 million. And the receiver then says, well, okay, I'm going to allow you this deduction over the next 20 years. So annually, I think it's a double L, 5%, I do the following. Over the next 20 years, every year, I can claim from the receiver 104,812. So how do I do this? Okay, let's go back to the detailed income statement. Now, you will remember I mentioned when we started out this morning, is that as far as the financial statements are concerned, the cosmetics, I'm not going to be bothered with today. So the idea is just to get the numbers across. Is the following. If I replace staff welfare, just for interest sake, with 13.6 allowance. Now, as I said, this is cosmetically not correct, but I just wanted to illustrate this. Now, and I bring it in because the receiver says every year for the next 20 years, I can deduct from my taxable income that amount. Okay. Have a look at it again. There's how much I paid for my 5 new and unused Snowdens. I'm allowed to include 55% of that in my claim against the receiver, quote unquote, as an allowance. And every year, I'm allowed to deduct 5% from my income. Have you got it? There we go. It's as simple as that. Now what happens? Where does this become really important? At the point in time where I've now increased my income. And let's do the following. I've now paid it off. Well, I paid a significant let me just see what I did. Yeah, it's correct. So what now happened is I've paid it off, or I've paid cash for it. Plus, I'm at the point where I've now increased, doubled this income. Let's say, for example, in year 10, what is, let's make it easy and say year 5. I'm now earning from this property 99,776 per year, and it's 5 of them. So this is what I'm now earning. Okay. So all of a sudden, I now have a potential tax problem. Now you see the difference. Because of the 13 secs, I make money, but I'm not paying tax. Because I'm allowed, in terms of 13 secs, to deduct that 104,000 in terms of 13 secs. Now this in itself is so significant. If I want to show you something, if I decrease, just for interest sake, that to 60,000. Have a look at that. I actually make money, but I don't pay tax. So that commission will still be there. As a matter of fact, at this point in time, I will not have my depreciation anymore. That would have be there, that's it, etc., etc. Plus, I will pay levies, and there you go. So, for this reason, something like Section 13 secs is of the utmost importance to the property investor. Let me just see. Okay, here's an important question from Sandile. If you have a look at the discussion, Sandile is asking, does Section 13 secs apply only to new properties? The answer, short and sweet, is yes. There are a number of requirements, and this is why we say go and have a look at the requirements of 13 secs. In the notes, it is set out in all the detail from page 18 onwards. Sandile, the important thing about this is, basically the requirements are the following. The taxpayer who's going to claim 13 secs must own a minimum of 5 properties, and each and every one of these 5 properties has to be used for business purposes. In other words, they have to be rental properties. So if in the one your cousin who's at university is staying rent-free, then it doesn't qualify, because then you only have 4 properties in respect of which you're running it as a business. So all 5 of them each and every one has to be rental property. And then the importance is this: at least one of them has to be a new and unused property. It means on the date of registration in the name of the company, it has to be brand new. Like Greenleaf, like Springglades. The reality is Snowden is not a 13 secs property, simply because they're 3.5, 4 years old. I just used the Snowden as an example to make believe or to demonstrate the principle, and it's nice and handy, the numbers. So if you own 5 properties, all of them tenanted, Sandile, then what happens, and if only one of them is new and unused, then the numbers change to the following: that your 13 secs claim is only in respect of the one property. There we go. And have a look at how it changes your numbers. Look at that. Now, all of a sudden, because you only have one 13-sex property, you now have a taxable income of 1881. And there you go, tax. Okay. Now, just to make it easy, it means if you have no further expenditure, your tax liability here will be that. It's because you have one 13-sex property out of the 5. And this is the reason why, as far as possible, we try and purchase new and unused properties, because for the next 20 years, we have this tax holiday. Okay. Now, you will remember that we had 273 here, 445. So at the beginning, when you're still paying interest, you're not going to be bothered because you have that interest deduction. So yeah, that's a loss, and you can carry that loss over to the next year. And at that point in time, for example, you still have your computer depreciation, etc., etc. And if you look at it from this perspective, there's how your 13-sex allowance changed. Okay. So Melanie, I hope I answered your question. So summarize, 13-sex is crucial, of extreme importance for us as property investors. Because again, it is, if you look at what we've done here today, all of this, let me just see. Okay, great. Thanks, Similani. Sandile. What we have to understand about this, my property investment activities in the company is a business that I'm running, and I have to approach it like this. And my bookkeeping and my tax planning has to be in line with what is expected of running a successful, lucrative, and rewarding business. Because once you retire, this thing will provide you with wealth. And after we're dead and gone, our children and our children's great-great-great-grandchildren will enjoy the benefits of this, because we approached it as a business and we ran it as a business and we let it grow. Now, the other interesting thing that we learn from this is, if we consider this for a moment, that if I want to continue building, I have to reinvest continuously. It means whenever I can afford it, I have to invest in additional property so as to get that interest deduction, for example. But it gets to a point where, of course, I now want an income from this. So that's where planning, estate planning, annual financial needs analysis becomes important. Because if you know you have another 10 years until retirement, then you know these numbers will have to be thus that when you retire 10 years from now, there will be income. Or alternatively, if I haven't paid them off by in 10 years' time, I would have to potentially resort to this guy and take from my retirement or my lump sum benefit that amount to pay off my bonds that still remain at that point in time, because I've demonstrated to you taking that third, even though I'm going to be taxed on it, will give me this income, which I certainly wouldn't earn in the retirement fund itself. So when we do tax planning, estate planning, retirement planning, and financial needs analysis, then we take all of this into account. And I hope you see how important tax actually is. And I hope I didn't confuse the living daylights out of you. But the truth is, if you look at it from this perspective and you look at the numbers, then you can see tax is great. And what you can do with tax is ingenious if you look at everything that's available. Now, I know I've outstayed my welcome and estate duty we haven't dealt with. It is in the notes. The important thing that I wanted to show you about the estate duty very briefly. We've done capital gains tax, we've done 7C, there's our 13.6. The problem that I have, one of the major reasons why we don't keep these assets in our personal names is the following. Let me just do this quickly. It's going to take a minute. There we go. Now, the problem with the estate duty is the following. The value is, for example, by the time that you hit the deck, it is, for example, 20 million, because you've now kept all these properties in your personal name. Now the problem, yeah, let's cut it there and put it over there. Okay. Now the problem is my executor's fee is the following. Multiplied by 3.5%. Wham, 700,000 gone. If I, in a situation where my estate now has zero debts because my life insurance is paid off all the bonds, then my estate duty is calculated as follows. Because I don't have any expenses, except, of course, that roughly multiplied by 20%, 4 million rand gone. But it doesn't end there. Because what happens now is I have capital gains tax in my deceased estate. And how does that calculation work? Let's say, for argument's sake, I have accumulated those properties at, what did we call that amount? Let's just see it. I had it here somewhere. Okay. We'll just fill it in. What was it? 762, 300 multiplied by 5. And that's what I paid for it. Okay. And now what I do is I have to, because I'm a natural person, I'm allowed to deduct in the year of my death 300,000. And my inclusion rate as a natural person is 40%. And my marginal tax rate upon death was 41%. Voila, there's my capital gains tax. Now, if you were married out of community property with the accrual, then there's going to be accrual as well. But for purposes of estate duty, how does it work? It's the following. Those are my expenses. So what I have to do is I am left at the end of the day in my estate with my original 20 million minus executor's fee, estate duty, capital gains tax, and they all add up to that. So what do I actually leave to my heirs? 12 million out of the 20 million. Now, guys, look, if this is not the strongest possible argument not to keep your property in your personal name, then I don't know what is. But these are the realities, and this is why we actually include estate duty in this. Okay. Now, we've more or less dealt with the important taxes. I think I'm at the point where I can stop this share. I believe we've run out of time, so I don't know if there are major questions at this point in time. What I would suggest, I must maybe just ask if there are some serious issues at this point in time. Alternatively, you guys can send me the questions. Let me just ask you this. Any one of you who have urgent questions at this point in time?
If it's not too much to ask, on that example where you do the 20 million and you end up with a 12 million you bought with your personal loan.
Sorry, Sean, the volume is a little bit low. Just repeat that.
So is it possible just to maybe do a comparison of the 20 million when you did, what it would be compared to in the company? So you leave only 12 million to your heirs. What would it be had it been in your property company, if you don't mind, just to compare them? Yes.
Okay, I can actually, I don't even have to run the numbers. It's 0. The reason, let me show that. I'm gonna. I think Sandile waved goodbye. Sandile, very nice seeing you again.
No, actually, I'm saying I have a question.
Oh, okay. We're going to deal with that. Let me just quickly, Sandile, explain to Sean. I'm just going to share this screen again because I have to admit this is really confusing. If you guys, do me a favor, have a look at the structure. Again, if you have it at hand. The reason why we have this shocking estate duty implication here is because it is in your personal name. Now remember, have a look at the structure. You will have in your deceased estate, if you do it right, like you have done it right, Sean, one single share in your personal estate out of 1,000 or 1,000,000 shares in that company. The trust will own 999,999 shares, for example. You will own in your deceased estate one measly share, which the value is negligible. So in other words, because the properties will be sitting in the company and the company sort of almost exclusively belongs to the trust, it means none of those assets will be in your deceased estate, which means their deceased estate will be zero, not 20 million, because that value is sitting in the company. If you take that away and you make that zero, have a look at what happens to the rest. They disappear because those assets will not be in your personal estate anymore. So the answer is as easy as that, and I understand why it's incredibly confusing, because we've crunched numbers for half a day now. So Sean, I hope I answered your question.
Thanks, Gert. Got it. Thank you.
Great. But you see, you remember you and I spoke about it previously. It is confusing if you don't keep your wits about it. But this is exactly why we spend so much time and effort on those every single year on developing those structures. Okay. Sandile, you had a question or two?
Yes, thanks. Two questions actually. The first one is, at what stage can you be able to incorporate the usufruct concept on your primary residence? Is it during at the time when you buy the property, or any time you can apply the concept? That's the first question.
Yeah, it's
then the second question.
Sandile, what I suggest, don't forget the second question. Let's deal with the first question first.
Sure.
Look, if you don't own the property, you can't sell it with the retention of the usufruct. So it means you have to own it first. Now, as you would have gathered from the explanation in Table A and Table B, it becomes evident that if you want to apply that structure, you want to actually do it as young as possible. Because the younger you are, the bigger the value of the usufruct, and the smaller the value of the naked ownership, which means the less potential to pay any transfer duty. And let me share that document again, just to demonstrate that. Can you see it? Actually, probably not. I should have shared it first. Okay, let's have a look again at usufruct. So for argument's sake, the longer you hold on to it, the higher that value is going to be. So you actually want to do it as early as possible. And the longer you wait, the older you, of course, become. Because the younger you are, the longer your life expectancy, according to the receiver of revenue, and the lower the value of that bare dominium, as we call it. It's just naked ownership. And the higher the value of that usufruct. So to give you an idea, if you wait another 5 years and that's now gone up to 4 million, have a look at what happens with the numbers. You see. So that will go up. Now, if you do it at this point in time where it's, then of course, it's all about money. How much? So that's the first answer to your first question. Okay, Sandile?
Okay, thank you. The second question goes back to earlier in the presentation. I didn't quite get the role of the incorporated company in the structure that you are proposing.
Okay. Well, look, the incorporated company is, if you're a professional practitioner, an engineer, a doctor, attorney, nowadays probably advocates can only also practice in incorporated companies. It might be interesting to get Bianca's opinion on it. Or any professional career or a practice. So what happens is, if you practice in your personal name, in other words, not in a company, you are engineer Simelane, practicing as a sole proprietor as Simelane in consulting engineers. What now happens, the moment that you reach in your practice this stage where you earn more than 1,577,300 per year, you will be paying 45% income tax. So to avoid that onerous taxation threat, you will then go ahead and register an incorporated company and practice your professional practice from within that company, because then your tax rate will come down to 33% rather than the 44%. But what happens is, you will pay your tax of 33%, for example, in the company, but how do you get the money out of that? And the important thing is, if you have a look at that structure, is you tie that into the bigger picture, where you can invoice from one of your private companies for services rendered to the incorporated, and then remove the money cheaply from your incorporated company. And spread income. I hope that made sense, Simelane.
A lot, it does. Thank you.
Okay, because I seem to remember that you're in the engineering world.
Statistics, actually.
That's it. That's it. I have it now. So I hope, yeah, you saw a lot of material today for statistics, didn't you? But yeah, so that's why it's important in your life that when you start practicing for own account, that you can do it from an Inc. Initially, what I would do, Simelane, is if you're at the point in time where you, for example, your income doesn't exceed, let's say, for example, say 320 per year. Now, that's going to be quick. But let's say for the first year, your income doesn't exceed 320. What I would then do, I would practice in my own personal name as Simelane Statistical Services, or whatever would be the choice. Because your tax rate at that point in time would still be 26. But the moment that in your planning and in your budgeting, you see, oh, hell, I'm going to exceed that within the next 3 months, that's the point where you would immediately register, pick up a phone, call Uncle Gert, and say, I need an Inc. And get it done quickly and register it with your professional body, your statutory controlling and oversight body, and then move your business. And by that point in time, what we actually do is we sell your practice to the incorporated company. And we create a shareholders loan account with all those nice tax gains that I explained today. So it is determining when your tax levels will exceed certain thresholds. So Melania, I hope that made sense.
Very much. Thank you, sir.
Great. Anybody else who had a question? Well, look, if there is additional questions, please feel free. And let me just add this. Everybody, if you feel that it is a lengthy discussion, just pick up a phone and arrange with for a consultation. And then we do a Zoom consultation. If it takes half an hour, then so be it. Or even if the duration is more than that. So please make use of that, because this planning, as hopefully you would have seen today, is of the utmost importance, because it makes an incredible difference in money in the bank and money in the hand, or alternatively, money in the fiscus. Happy with that? Anybody else?